I'm understanding is probably distribution, sales, people, and pivoting.
Sure.
These are the four areas which you think are important.
Right.
When it comes to sales, right, it's not an easy thing to
Right.
do, and not everybody enjoys it
Right.
because it involves rejection,
Right.
right? It's psychologically, it may not be the best experience you may have, right?
Right.
Because all of us think that we are great at X while we get rejected for X when we try
Right.
to convince people, right?
Right.
So about sales, how do, especially in B2B, right? Because that's where you have a lot of experience. How should people go about it, or how should they, if they're building a SaaS company, for example, or anything which is a layer, right, on top of existing businesses?
Sure.
How should they plan for it? In case the founder, let's say, already knows that I'm not good at sales,
Sure.
right?
So you need to have a co-founder who understands sales, right? This is one thing which we look at a lot of these B2B companies. So for us, even a product we can compromise, not on sales, right? So you need to have enterprise sales guys who can come in and start selling for you. So either you need to have a co-founder, which is the best thing, and in case you don't have that one, then probably don't start the startup.
Right.
That's the second thing. In case you're struggling, there are a lot of channel partners who tend to sell for you.
Right.
But then it's more like you're going to Amazon and asking Amazon to sell for you, right? Now, either your product is so amazing that it'll sell. Otherwise, channel partners can just boost your sale a bit, open up new geographies. But in case you're not being able to sell in your base geography, then chances of a channel partner selling your product is low. So you can't say that I don't enjoy driving, but I want to win Formula One, right? So there are basic skill sets required for certain companies. Try not to start something in that zone unless you are comfortable about it.
Right. And about pivoting, right? When do you know that it's time to change direction?
Right. It's a tough question,
Yeah.
right? The thing is that you tend to work towards a goal, right? And you don't meet your target. You know that there is something wrong and you need to change something. You do that adjustment and run the process again. Now, in case you again get a negative result or not so positive result, you pivot or you fine tune for the second time. Now, for me, 3 times is, I think, good enough. Now, in case you're not being able to, let's say, grow after 3 iterations, then it's time to pivot because either the product is not fit for the market or you as a founder is not fit to run that particular product. Now, there are cases where people have done it in 7, 10, or 15 iterations. Always the cases, right? But why do you want to take a hard road? Right? You want to build a business, so build a business which is a lot easier or in your comfort zone then.
Do you have those conversations with founders after you're back then?
Yeah, these kind of conversations tend to happen quite often about the kind of product or the services mix they need to have. Even sometimes, let's say, changing the teams and all that. Because once you're working, you get emotionally invested into the company. And though you know the answer, you generally don't want to execute. And that's the point you want to have investor or your mentors as a sounding board to be able to work it on. And a lot of time people haven't seen the experience because what happens is in case you haven't experienced failure in the past, you just continue to hope that things will work out one day. But then once you see people who have seen failure a lot, they know when to stop. Right? So that's the place where you need to start looking at investors, mentors, or even your family for support and running your ideas again and again.
But as a founder, do you think it's easy to reach out for help outside your investor base?
It's actually the ecosystem is there, right? Now, in case you feel shy about reaching out, then that's a personality trait which should not be there in the founders. It takes time to come out of that hitch because a lot of time we feel awkward reaching out to people, right? But that's something, a skill set you need to learn. In case you're not being able to learn, just do a training on that.
Right.
right? Because a lot of time, once we previously talked about enterprise sales, right?
Right.
Now, one of the things is, in case you're not confident, you start doing the enterprise sales training. You start doing trainings on negotiations and all that, right? In case you don't know how to drive and you want to still
Right.
go for Formula One, then you start learning about it, right? What you can't say is, I don't know about it, I don't even have time to learn. Then you are wasting your time.
Right. Right. So you need to start walking towards your destination. If
Yeah.
you even if you're walking at a slow pace.
Yeah.
So it's also growth mindset, learning new
Right.
things, right?
Right.
Which I think is important as a founder, right? Because every situation is going to be different.
Yeah.
Even every sales conversation will test you in
Sure.
terms of what you can bring to the table, especially when you don't have credentials in the beginning, right?
Right.
Because people will ask you tough questions,
Yeah.
right?
Right.
So the idea is to not take that personally, and then also seek mentorship, right?
Sure.
Um, Also between product and sales, right? A lot of founders, you said, they are in love with the product. They spend a lot of time on the tech side thinking about ideation, but the commercialization bit is lacking.
Yeah.
Right. Often we see that the average product with the right commercialization can see success,
Right.
while a good product with poor commercialization can still be a failure.
Right.
Right. When you are meeting founders, a lot of time probably you are meeting at idea stage when you have not seen not the product or the commercialization bit, right? Now at that point, how do you take that back?
A lot of it is background, right?
Hmm.
So what you have done in the past, in case it aligns with what you are trying to sell, that's one thing, right? Secondly, in the sales, you need to present your idea. So when you are presenting your company to us for investments, your sales skills start showing,
Right.
right? So that is the second check which tends to happen. And a lot of time, let's say we don't meet very early stage founders. Once you've got 5-6 months run of your startup, right? That's the point how your GTM strategy has been built, right? Is it
Hmm.
something I'll just do Facebook marketing, or you have thought about it that this is the kind of ROAS I'll get, these are the channels I will go to, and this is the amount of time I'll invest. So you understand the space or not,
Right.
right?
Right.
So once you get to those kind of details, chances are that you will probably make a decent bet. But again, a lot of time you can't even judge a lot of these things.
Right. Right.
Right?
So it's like I think it's like a box of chocolates. You don't know which one you're gonna get.
No,
I
no.
think if you take out the background bit, right? Let's say,
You're taking out everything.
I'm just trying to think how to phrase this.
No, so one of the things which I want to probably differentiate, this is not a box of chocolate where you need to test out 200 chocolates, right? The thing is, in case you are coming to sell me your project or your company, right? Now, in case you don't give me the confidence that you have the skill set to sell, I'm not going to invest, because out of those 200 chocolates, I need to just eat one.
Right.
Right? So there would be 5 guys who would be able to at least sell me how they can sell their product. Right? So what I'm not doing is, I'm not judging each of the companies on their merit. My job is a lot easier because I need to just select the best one among 200.
Right.
So it's not my job to bring out your strong points. It's your job to bring out the strong points to me. Because in case you can't sell your company to me at this stage, chances are you may not be able to sell your product. That's a very generalized statement.
Right.
But that's like a kind of a thumb rule which we tend to follow.
Right.
And makes our life easier.
So beyond initial traction, a lot of energy and difficulty comes in when you think about scaling. Right. Now scaling, as we discussed, is a totally different animal, requires totally different mindset, and there are many ways to scale. Right, it depends on the business and the segment you are playing in. Right. When it comes to scaling, we discussed about mistakes which founders make at idea stage. But beyond commercialization, when we talk about scaling, what are some of the mistakes which founders make at scaling stage?
So normally, I think we can probably break it down into a B2B and a B2C sales, for example, right? A B2C product, chances are that you tend to stick to the strategies which worked for you from 0 to 1.
Hmm.
right? In case you're able to sell on Amazon, right, you can sell probably a crore, 5 crores, 20 crores, but then you will plateau out.
Right.
In case you continue to run the same strategies from 0 to 1 to 1 to 1000, that's not going to really work out there. So you need to change your channel mix, for example. Then you need to bring in the kind of guys who understand different channels of sales. So that becomes the key once you are running a B2C site, right?
Right.
But the founders tend to just work on the bit which was working from 0 to 1. On B2B side, it becomes really easy for us to see, evaluate. Now, one of the problems which we feel again founders is that they start hunting the elephants from day zero. Elephants are your large clients, right?
Right.
So till the time you have built your credentials, it's very difficult to sell to a large organization. So you need to build your bridges in terms of showing your credential, sell it to smaller guys, then to the mid-sized guys, and get to the larger guys. The larger guys will take 9 months to buy, while the smaller ones will take probably a month or probably 15 days to buy. So till the time you don't follow that structured sale process, which runs in large companies, which is freely available, but in case you don't run it even in a small company, chances of growth becomes, let's say, hampered. So these are the kind of mistakes which we see during the scale up, that you tend to apply the strategies of the 0 to 1 and 1 to 100.
Right. And that's also the point where you need to bring in experienced folks
Yeah.
into your team and be able to manage them and take them into confidence as part of your journey. Right.
Yeah.
A lot of young founders may not have that experience
Skill, yeah.
because they have not worked with people, and then a lot of them take difference in opinion as challenge to their authority or things like that. Right. So how should founders think about this journey, right? Because you're bringing in, let's say, somebody who's 25 years of experience into B2B
Alright.
as part of your, let's say, VP of or president of X or VP of X. Then how does that work out?
Right. So one thing is, I think this is a problem because of media hype as well. A lot of founders tend to feel that they are solving a problem because larger guys have not been able to solve that problem. The problem is that Reliance is not doing something what you are doing, because it's not worth Reliance's time to do that. So once you bring in a senior guy from a large organization into your fold, a lot of time founders still feel that they know everything, they themselves, right? Now, once you're bringing in the experienced guy who have scaled from probably 1 to 10, you need to start listening to their experience. You can discount to some level, but in case you have chosen your advisors well, they are showing you the path how you reach from 1 to 10, plus what are the kind of mistakes they have done in the past. So you can't just discount those things upfront, telling that I'm fast, these guys were slow. Then you don't really do those kind of guys, right? So what you really need is to get the right guys, and you need to have the temperament to listen to them as well, because that's the experience talking.
Right. And I think a lot of it comes again to interpersonal skills. How do you build rapport? Are you comfortable, not comfortable working with them in long term? And once you have good rapport, I think it becomes easier.
Yeah, right.
I think one of the reason which has taken this startup ecosystem on a different trajectory is the whole hype around funding.
Right.
Funding, fundraising, people are looking for investors, right? So when you think about founders, right, even before they have their pitch deck, they're thinking about fundraising, about valuation, already meeting investors, right? How do you think about that?
So that's probably the negative side of the ecosystem which we are playing in. A matrix which should not even be a matrix is being hyped about. And I think the problem is that that's the only matrix which is freely available. Whatever people have raised as what is talked about, because going down to their financials, talking about, let's say they made so and so profit, that's one not very jazzy. Plus, that's difficult work to dig out that information.
Right.
So whatever is available in the market, people tend to talk about that more. Now, that has actually, in my mind, just distorted the way the startups should be done. And that has increased the failure rate.
Hmm.
Because when I think about opening up a US office for my company, I would feel that I just need $100,000 to open up my US entity, because building out a US entity will cost you potentially about $4,000-5,000.
Right.
Plus, you hire a sales guy because the product is being done in India. In case the sales guy doesn't work for 5-6 months, then obviously you're going to fire. Now, a base salary for a US guy needs to be about 100-150K, not beyond that. Rest everything needs to be commissions, right? Now, once I look at founders coming to me, I need $1 million because I want to start US office.
Hmm.
While in India, their revenues are hardly about $1 million, right? That's the place we see the disconnect happening between the business and the funding. And then people start feeling that other company got the same amount of funding with less revenue. I should be entitled to get that kind of funding. That just distorts the whole perspective from building a business to getting funding. Now, getting funding is you are taking liability, while building a business is you are creating an asset.
Hmm.
Right? So somehow I think because of all the probably the noise in the system, the basics have actually been changed for certain startups. Now, there are certain places where funding is important, where you're doing something in deep tech, where you're doing something in the space field and all that stuff. So there, a lot of these things become relevant, but not in a basic kind of a startup which is doing what other guys are already doing.
Right. And I think a lot of it has to do with, let's say, not having understood the cost of capital.
Right.
Right. So one of the important concepts or subjects which people tend to, undervalue is accounting.
Yeah.
Right. Accounting is the language of business, and people need to understand that investors' money is not
Sure.
free. Right. So I think that's also something which founders should try to
Right.
understand more.
Right.
And as they grow further, I think this becomes very critical, right?
Right.
Understanding accounting, understanding SHA, and what kind of agreements are you signing.
Right. So one of the red flags for us is when we talk about valuation with a founder, and founder says my CA did it,
Hmm.
and this is my valuation, we are anyway going to decline. We don't go beyond that.
Right.
Because as a founder, you need to understand what you're asking for, why you are asking for, and what you would be doing with that money to grow. So that's the basics.
Right. And how do you value a startup, right? That's another thing, because generally we are talking about either we are thinking, okay, cash flows, we don't know, right? And so people are using, some rule of thumbs, maybe applying some multiples, looking at some comparables.
Right.
But what is the best view? Because you have so many, entry and exit points
Yeah.
at so many early stage companies. How should we think about valuation?
Right. So it becomes a lot easier once the founders have done 4-5 crores revenue, because then there are thumb rules in each of the industries that in case you're a SaaS founder, you will get 5 to 7x of your revenue, for example. Currently, D2C founders can get about 2 to 3x, for example. So the models are set once you start growing.
Right.
Now, once you're at an early stage, right, for the investors, that's the point you need to look at the management quality, and then you need to look at the growth potentials, and a lot of those subjective things come into mind, and that's
Right.
what makes it a lot riskier, because now you're taking a bet not on the market, not on anything, but your ability to predict the future of this startup, that the founder will work out, the markets will work out in the favor, execution will be fine, and that's why you are taking a bet. So at early stage, more data points you get about the founders and the business, it becomes slightly easier to value a startup. But normally, let's say what you see is that what's the 5-year outlook of the company, right? So 5 years down the line, if the company is saying they will do 100 crores in revenue with I don't know, a 10 crores PAT, right? Look at the market multiples. That's the valuation the company will get in the market in case they list after 5 years. Right? That's your base. Now, whatever is your IRR, you want to make 10x money in 5 years, you just discount it back to by a factor of 10. So that's the max value you can give to a founder at this stage. Right? And then even at the early stage, the idea stage, there are certain thumb rules which people have now started setting, that in case you're a pre-product, I'll give you $1 million. In case your product is done, I'll give you probably $2 million. So those kind of thumb rules you need to work with.
Right.
Yeah.
What about angel investors? How should they think about valuation? right? Especially, let's say if you are giving a sizable check, let's say 1 CR or more, or even 50 lakhs, right? Now that's a lot of money for an angel investor, because that he may be allocating a part of his savings, right, to early stage ecosystem. In case they are not doing it through an angel network or through a syndicate, if they are doing, let's say, direct capital investment, then how should they think about? Because in that case, probably at idea stage, they are the one who are anchoring the whole thing, right?
Right. So, in case you want to become an anchor, right, you need to understand the company inside out.
Hmm.
Else, you're not an anchor to that company, you're just throwing in money, right?
Right.
So, generally, anchors come in the industry in which they have a understanding or they know the founders from before, right? In case it's Kulmani, for example, right? I am fine putting in money because I've seen him for 15 years.
Right.
He will do something, right? So, and hence, I'm fine putting in money, right?
Right.
Otherwise, you understand the industry well because you are working in the same industry or you have seen the same gaps as what founder has seen, and potentially you might be able to help founder navigate certain things. So, a lot of these subjective factors start becoming a lot more important in early stage investing, and that's why it becomes a lot more gamble at that stage
Right.
because you are looking at 5 factors, but then you are discounting 10 other factors which you should have looked at. How the compliance will be happening, whether the founders has got staying power. If the company doesn't work out for 2 years, would the founder bail out? Right? A lot of those factors you just tend to discount, and that makes the whole proposition very risky for you.
Right.
And that's why you should not be putting your safe money into startups at early stage
Hmm.
because that's not the place it should go.
Right, right. I think when you talk about comparables, right, especially if there are startups which are at the intersection,
Hmm.
probably a new emerging area or a theme, or let's say something like AI, or even let's say health tech or fintech. Let's say talk about like last decade before PTM, right? There was no precedent, right? There was
Sure.
nothing you could compare it to because UPI still we didn't know about the potential, we didn't know how many transactions are we going to see,
Hmm.
and the adoption we were not clear about, right? And if you could see that at that point, you probably made a lot of money because
Sure.
you probably took bets in fintech, whether in the payment space or other sectors within fintech, right? So how do you balance that, right? So one is the rule of thumb where you're comparing it to existing or something which you have seen,
Mhm.
or let's say in your comfort zone where you are operating and you are becoming an anchor, right? But if you're thinking about forward looking, venture seems to be forward looking than backward looking. Well, any investing is forward looking, but still in public markets, there is a track record you can compare to, right? So, how do you do that? How do you do forward looking investing as an angel?
Yeah, so that's a place there is a sophisticated investor and there is just an angel investor, right?
Right,
A sophistication comes from your experience, right? So the idea is that there are probably 150,000 startups in India,
right.
right? Now, why do you want to go outside your comfort zone? And for example, I don't know anything about pharma market, right?
Hmm,
Why do I want to go and take a bet in pharma market when there are 10,000 startups in the fintech market, which I understand well,
hmm,
right? So that diversification into pharma market needs to happen a lot later in your journey
right,
compared to doing early on, because then you have got, once you've seen, let's say 10,000 startups like us, right? Then you start bucketing those startups into, let's say, certain classes, and then you are able to value them slightly more scientifically, right?
hmm,
But in case you don't have a data early on, don't venture into the areas which you don't understand so well, because then you're not taking a calculated risk or bet, right? So the whole point is, in case you want to gamble, you can gamble anywhere,
hmm,
right? But in case you want to invest, then you need to do your analysis on the companies before getting in,
right,
right?
right,
So a lot of time people are getting pulled by the fact that someone made 500x in Swiggy or somewhere else, right? Now, in case you want to gamble that thing, go to probably Atlantic City, right? In case you put in money on number one, it comes in, you will make 36x,
right,
right? But that's not what you're doing while you're investing, right? In case you're gambling with Swiggy, do that. But in case you're investing, then you need to do your analysis, only then get in,
right.
right? So that's why what we say is that once you are a sophisticated investor, the risk goes down significantly just because you understand the risk and you're doing your analysis. In case you're getting without analysis, then you're gambling, you lose money, then don't cry for me.
Right. So what I'm also hearing is that if you're doing large checks as an angel, you need to be an active investor.
Yeah.
Right. So you actively needs to seek new themes, learn about the market, and also be involved after you have deployed money.
Exactly.
Unless you have the bandwidth to do that, you should not write large checks.
Large checks is again compared to a wealth, right? In case you
Compared
do have
right.
thousand crores
Exactly.
lying around, a crore doesn't mean much, right? So you just put in money.
Right.
But in case your salary is only, let's say, I don't know, 50 lakhs or 1 crore, whatever SEBI prescribes, let's say it's only 1 crore, right? Then putting in 5-10 lakhs check is large. It means something to you. Then you do the analysis or write on someone else's analysis. Don't go in blind into the pool.
Right. So you're saying go with syndicates or networks which have good reputation, have the track record, and invest through them in smaller checks.
Right. Either syndicates or even your friends, right? So in case I want to analyze a pharma company, one of my friends works in pharma, I would at least have advice from him whether this product even has got legs or not. Right? So even if you want to go solo, no problem out there. Yes, syndicates are a lot safer because there is a lot of analysis which is already being done. But even if you want to play on your own, just play with the right set of guys. Don't play alone in the field which you don't know anything about.